Let's turn now to the markets. We're joined now by Ed Clissold, Chief U.S. Strategist for NDR. Ed, great to have you with us. Let's start with cryptocurrencies. We were just hearing from Jared breaking all of that down. Of course, we're seeing that it is tanking, Bitcoin tanking, Ethereum tanking. They're all tanking across the board pretty much. Wondering if you think this is a time to really get in big with crypto, or is it time to dump it if you have it and stay away from it if you don't?
Well, it looks like Bitcoin in particular is breaking some key technical levels. So if you follow the charts, that may be something you want to pay attention to. The bigger picture has to do with whether or not crypto will be adopted, and Musk's comments last week blow a hole in that, and whether or not that stays and continues to be the case going forward remains to be seen. But the adoption story, with institutions using it as an asset class, with people using it as a medium of exchange, that's a bumpy ride. And when you have the biggest proponent, calling that into question, certainly that's going to be a negative for cryptos in general for the time being.
So then, what purpose should crypto play in a person's portfolio, do you think, and how much of it should they allocate to that risk-on asset?
What this reminds me of, to a limited degree, is what happened with commodities a couple of decades ago, when institutional investors looked at it as an asset class where it really hadn't been before. And they ran up, and then for fundamental reasons, commodities came back down. And our institutional clients, haven't been asking about commodities as an asset class to the same degree as they were. So I think it does have a place long term in a portfolio, but it needs to be a small amount. It's certainly speculative at this point. If it does become widely adopted, then it could have a 5% or so benchmark to somebody's wider portfolio.
All right, looking at the broader markets now, Ed, wondering what you think the biggest risk to equities is right now. Is it inflation? Is it something else out ahead? Because we've been seeing a lot of choppiness in the markets lately.
Well, I think inflation is driving the headlines, but that's symptomatic of a bigger transition. We've been going from the most bullish set of economic data and parts of the economic cycle that we've seen in a decade. That is, when you're coming out of a recession, data is bad but improving. That's what stocks love the most. But once you get into the second year of an economic expansion, reality sets in. We're not going to grow as quickly moving forward. And so inflation is an example of that. We have a $20 trillion economy. You're not going to grow double digits quarter after quarter after quarter. It's just not set up to do that. But other data points are also supporting that. If you look at, say, the output gap, which measures potential GDP versus actual GDP, when it's negative, that is, the economy is below potential, but getting better, that's great for stocks. But the output gap is narrowing rapidly. By the time the output gap is closed, that is, the economy is growing at potential, stock gains are usually pretty muted. And that's where we are right now. It's a bumpy transition, and usually you get bigger corrections as investors adjust to the new reality, which is slower economic growth and slower earnings growth.
Ed, we're coming up on the halfway point of 2021. I can't believe it's coming that quick, but we're going to be there in the matter of weeks. What are you expecting for the second half of the year? Is it going to be a weak one for the stock market? And if so, what would the catalyst be?
I think, the second half is most likely going to be weaker than the first. We had a good start to the year. In addition to what I just mentioned about the economic story, is that earnings growth has been fantastic, but by the time you get the really good numbers, which we're going to get in the second half of the year, if you look at 4-quarter total earnings, are going to be well over 20%. Consensus is for 50% earnings growth this year. When you get numbers that big, by the time they're actually reported, stock gains tend to be weak. And then the calendar turns, people start focusing on 2022 earnings, realizing they're not going to be as strong. And then you can get bigger corrections in the second year of a bull market. Double-digit corrections are not uncommon. And then we can reassess from lower levels, lower valuation levels, prices come down, earnings are going up. PE should come back in line. And then we can set the stage for probably a longer but slower pace of gains in the market.
So knowing all of that, then Ed, how should investors really approach their portfolios right now, knowing that there is more volatility up ahead, knowing that we're seeing this rotation in and out of growth, particularly those tech names? You just heard what Jared was saying about tech essentially clawing back some of those losses today, although that sector is in the red right now. How should investors be allocating some of their portfolios at this moment?
Well, mega cap tech has taken really a defensive characteristic. So on big down days, the big cap growth names may actually outperform a little bit, but there's still another leg to the economic reopening, which should favor cyclical value stocks for a little while longer over the pandemic stocks, which tend to be more growth oriented. In addition, there's a whole other segment of value that is the defensive value names. Think utilities, telecom, consumer staples. They're low beta. So in the last year, low beta has been a terrible place to be. But if we go to a choppier environment, maybe low beta value areas would be a better place to be. So all that combines value probably doing better than growth for the next several months.
All right, Ed Clissold, Chief U.S. Strategist for NDR. Thanks so much for joining us today.